Hello, everyone. Good afternoon. Welcome to our latest seminar on retirement income planning and the importance of planning for life after work. Today you have me, Jeff Goldmintz, and Kelly Taylor presenting on this. So with that being said, let's get into it. So today what we're going to cover are the main shifts in retirement, how we assess building your future, the benefits of having a plan. We're going to get into the income layering, the pension splitting, the tax management, CPP, OAS, RSP conversions to the RIFs, estate goals, what matters most, health of your wealth, explain our process for creating your plan, and we'll finish with a case study. So a lot to cover today.
The real goal is whether you're in retirement now or in savings mode, there are specific planning strategies and certain mindsets that will directly impact and improve your quality of life and sense of security and confidence. So it's true what you said, Jeff, in the previous slide, where it's about mindsets. And we're going to cover a lot of that content and really make sure that we're focusing on what matters most to you inside that plan.
So this chart right here is really interesting. This was a study that showed how people view complex needs for investments. So on the top right here, this is the most complex required needed for a plan. So that's generating a comprehensive income plan. So what does that entail? So that's estimating how many years your assets will last, developing a specific plan for your withdrawals, and just creating an overall plan. As we get down to here in the bottom, what you'll notice is that there are easier tasks, so determining what the income and expenses will be. We want you to be more high maintenance. We want you to know your income and expenses. So whether if you have your own plan for tracking your expenses, or if you need help, you can always send me your statements. We can always crunch the numbers. But overall, we need to get your collaboration to figure out, okay, what are my expenses? What's my income? How much are we saving? Very important topic.
Yes, Jeff, I agree. Like it really is a mutual process, a mutual engagement, I would say, where a lot of the fun activities can be contributed by each client and each household. For example, where you're going to travel or what new hobbies you're going to enjoy, and we can contribute a lot of the expertise around it. So I think it really goes to show that there's a number of different topics, and we have that expertise in not just creating a savings plan and then moving into a retirement plan, but at the pinnacle of that is really having a retirement income plan. So it's almost like a blueprint or architectural drawings for how your assets will eventually be creating a stream or a river of incomes for you from multiple different places. So it gets a lot more complicated, and we can kind of contribute that in terms of the retirement income planning. The analogy really is if the front 9 is our savings years, so it's pretty simple. If everybody knows that old adage that you should pay yourself first. So if you pre-authorize savings, you really need to know your numbers. Like that is really the foundation for all of this. And a lot of people have kind of latched on to that self-directed concept of owning their financial lives. We agree that that's a great concept. So knowing your numbers is really choosing that lifestyle level and then saying, okay, well, if I make this much, what's the differential? So what's that annual savings target? It's pretty simple, but a lot of times common sense isn't common practice. So we can kind of help people make it more of a fun game. And it's really simple to pre-authorize your savings, and those accumulation years are really, the analogy might be around a golf then. So if we're savings and going through that savings years, on the next slide, we kind of show that the back 9 isn't, so that's your retirement income years. It's not really a back 9. It's not really the same game as golf. It's almost as if you would step onto a fresh sheet of ice playing hockey. You need different equipment, you need different skill sets. It's a totally different game. So instead of just pre-authorizing one number to savings, we're going to take, a number of different assets that you hold. Those are the best plans, is that we have a number of different pools of assets to draw from, because the goal is going to give you a stable income stream. So then if we have a number of different streams of income from different amounts at different time frames, that's where it's quite a lot more complicated. And I think it's just important for clients to know that the game kind of shifts. Even from a mindset angle, it's hard for some to change from saving and building their net worth to then deaccumulating or starting to withdraw and see their net worth shrink. So there's ways that we can kind of help with that, but it really comes down to using your money and time as tools to get what you want out of life. But it's we'll make it a game, and we'll make it fun over time. So with building your future, we'll not only assist in refining your plans, but it's really those regular reviews. We've long since suggested that continual contact makes the difference. So for some of you, that's every 4 months. For some, it might be 6 months. But we find if we miss those connection points, we just don't have the same level of communication and confidence as a group. So in building your future, it really comes down to the cumulative progress that we can make with those regular connections. And as we're seeing now, with these crazy times that we're in, and even with market volatility that's happened in the past as well, there are going to be those ups and downs and those breakdowns. So it's a question of how prepared are we to treat those as opportunities. And I would suggest, like in the current case, we've been preparing for almost 18 months for our average client and our average household with that. So we can definitely use this time as an opportunity. And instead of being off track because of these unexpected situations, we almost might be more on track or treating them as an opportunity if we can say, for our long-term investment assets, we had better buying opportunities at this point. So as we all know, the only thing constant is change. It's just a question of how prepared are we to adapt to those moments of change.
And don't be caught with thinking that if you have a plan and it's just in your head, or maybe it's too early to start, or maybe you just can't see that far into the future. Just like this slide is showing with the sand on the beach here, we don't want your future to be writing in the sand and just have it washed away. We want to build a strong foundation and go as high as we can go. And everyone has a different story in retirement. So it's just a matter of finding what your story is, and we'll help build those chapters.
A goal written down is 5 times more likely to be achieved.
So when it comes to creating your blueprint, that's exactly what we're doing. Just like with a home, it's almost like we're building a home, but for retirement. And with that blueprint, the value of the expertise increases the longer the plan progresses. So our best plans, we're looking at 10 years before that date is even set up yet. And then we're reviewing every year, making the plan tighter and tighter. So as you get close to that point where work is going to become optional, you have the confidence to just say, you know what, I've been planning this for over 10 years. Pam, Kelly, Jeff, and the team, they've really put me in the right place to make this decision. So that's what we're trying to accomplish with this blueprint. It's just making sure that you have the confidence and that you have the security to make that decision, because that is a huge decision for the rest of your life. And we want you to have that confidence to do so.
And we often see major changes between those plans as they move year over year over year. We have those interesting swerves, or it's kind of a winding road, right? Is what life becomes. So in no plan that we did in year 1, in year 10 or 12, does it look the same as we accomplish that in year 1. So it's really the process that's key.
So there comes a ton of benefits for being ready for retirement and planning ahead. Here's just a few. So preserving government benefits and tax credits like old age security and clawback.
So that means if you want to maximize that OAS, the old age security that comes to you at age 65, we want to plan to smooth out your income from other sources so that you don't face big hits on your tax return when you're at ages beyond 65. So beyond 70 grand of income on your tax return, you might see that amount that you get from the government per month reduce. So we can prevent that for most of our files through proper planning.
The next benefit is maintaining an income stream that you won't outlive.
Some of you have heard of annuities where you can lock in that stream of payments and for life as a guarantee. There are other tools and products that are relatively new that we can customize to your file when appropriate. So if we can lock in a certain rate, might not be an annuity, but it might be similar to that. So guaranteed income is something that's more relevant as we get closer to grabbing those monthly dollars from your investment pools.
Another big one is being at choice with your time when you hit work optional lifestyle.
So that's really a difference from the word retirement. We're trying to get away from the words of retirement and budget. It's not really the case that people are wanting to delay lifestyle quality until the future. It's more of a balance of, how do you want to live today and this year? And then what does that look like for the future? In terms of when work becomes optional, do you stop? Do you change a career? What does that look like? So that's kind of our new terminology for retirement.
And later in life, living on your own terms as long as you choose to.
So a lot of this is not just a financial number, it's solved and you just move forward. What we really try to give people is that feeling of you're focusing on what matters most to you. You have that confidence, you have that security, and most importantly, especially as you age, you want choice. You want freedom of your money and you want to be able to do what you want to do. So that's what we try to achieve through this planning.
And having the power to impact those around you. And maybe that's not just with funds or money, maybe that's other ways.
So we challenge you, and that's where we have a really good line of communication with all of our client households. We treat it like a community. It's like one big family. So we'll challenge you to have some purpose behind your money. If that maybe is seeing the world for yourself and your spouse, that's great. If that's impacting some other generations or some charities or some society impact, it's different for everybody, but we'll have methods and tools to help you impact those around you.
And balancing your health and mobility with the quality of your life.
So it really is true that, if you have your health, it's the best way to enjoy what you want to accomplish in your retirement lifestyle. And there might be some methods or some tools and tricks that we share within our client community that will help you achieve that to a greater degree or a higher degree.
So one of the topics is income layering. Income layering is like baking a cake, a layer cake. Each layer represents a different income source, and collectively they represent your retirement savings. So we always want to consider using the least income tax efficient sources of income in the lower tax brackets and then build up from there. So income amounts and types will vary from year to year, and this is why we coordinate and integrate with accounting to get inputs on dividends. We can also have an impact on your net income. And then the icing on the cake is par. So what's par? That's the cash value in what most people have is their insurance policies. So that can be used as supplemental income in the later years of retirement, like age 80 to 90, to live your lifestyle.
And I think, Jeff, why you're suggesting that it might be the icing on the cake is that it's because it grows tax-free and can be accessed tax-free. So that's a very powerful tool if all of a sudden you want to spend, for example, let's say $70,000 per person in your household on your retirement lifestyle in any given year, and we're able to take out $50,000 or $60,000 from taxable accounts, and then where do you make up that shortfall? That's where you might come back to a tax-free savings account or a tax-sheltered insurance product so that we can get that money for a retirement lifestyle without paying undue tax. So the ingredients and the cake that you create for this income layering concept, like you said, Jeff, it might be different every single year. So, age 63 might be different than age 68 versus 74. So this is what we can help you kind of create and understand. And that's what we meant by it being a different game than simply saving. But what a lot of people as a takeaway from this slide is then it all kind of clicks together as to why we talked about having different pools of assets. So sometimes having commercial property or a rental home makes sense in the long run, as well as why we try to get people to get beyond just having RSPs and a mortgage-free home. There are other things that we need to invest in to really give you income stability or income certainty in your retirement. So pension splitting. So now we're going to dive into a few more tax consequences or implications on how to achieve more efficiency for that. So over the age of 65, this can also relate to RIFs, but some people have, like, for example, a teacher's pension. You can split some of that via the accountant with your spouse so that we equalize the income per year. So it's almost like we're going to help people better understand their annual tax returns and the income tax brackets. It was one of the handouts that we have that we can provide to you, and we sent previously in an email. We can provide another copy at request. But what we're trying to do is equalize the amount of income for both spouses in that household, because the first $2,000 of pension income is essentially tax-free. So then we want to make sure we're taking advantage of all the tax tricks, as well as that can come from the interest portion of non-reg annuities or from payments from a registered annuity. So really, if we don't have any other formal pensions from like a teacher's pension, we can just convert your RSP to a RIF earlier, and we'll get into that at a future slide, but we're just trying to make sure that we split all possible taxable income between the different spouses to make it more efficient or to pay less tax. So how does CPP and OAS work? This is a common question that we would obviously hear about for almost every household. The general rule of thumb is that if you're going to live until 100 and you're certain of that, that's when it might make sense to delay CPP. But the vast majority of people and the vast majority of our clients, basically the answer is, when do you take it, is ASAP. So as soon as you're done a lot of your other income or work, so if you've got some self-employment income at ages 61 and 62, maybe we'd wait until you don't have any more employment income, and then you would take it as soon as possible. What a lot of people don't remember, or they may forget, is that you can't just have a default assumption that both people in your household might achieve maximum CPP. So the Canada Pension Plan, if we just use an approximate amount after a small amount of tax, it might be $1,000 per month per person. But it might be the case that both people don't achieve that because you have had to have contributed the maximum for a long time period. So in certain circumstances, maybe you haven't contributed the maximum. Maybe if you're owning your own company, we've chosen to take a few years off and repay some shareholder loans or take dividends. That doesn't have you contributing to CPP. A trick for some females, if there was some years of mat leaves where they were raising some children in the home, you can apply back to get credit for CPP for those years. So it really applies to each file, but that's where the answer is. We'll take CPP, the Canada Pension Plan, as early as possible, and we'll help you calculate how much we're going to forecast for that. With old age security, that is at age 65, you can apply for that for every Canadian that qualifies, and it's really income tested. So as long as you don't have excessive pension income and money coming from other sources, you'll achieve basically the maximum of OAS. And if you're in that range, where you're beyond $76,000 of taxable income in that year, we can kind of help you apply tax strategies, as we mentioned, to minimize how much that gets clawed back or how much your monthly amount gets reduced. So for tax management concepts, income splitting, as we mentioned, and then that's as possible also on self-employment. So for example, if there's some work that you're doing through a company in retirement, or you've changed careers, we could maybe have each person doing a different job in that company, or splitting money from like a rental property or a few rental properties, for example. We can work with that accountant behind the scenes. And it's almost like an iceberg, to use that analogy. The normal tax concepts that most people are aware of are on the surface, but there's a lot below the surface that we cover to make sure that we're as efficient as possible, using best practices, keeping up to date on tax changes, which seem to occur almost every 6 months. There's different tax changes. So we'll assess our recommendations from a tax angle, but it's also important to note that we'll look at it from an estate or a survivor angle too, because that's where there might be a rollover provision between the first death on one spouse, but then on second death, there might be some really heavy tax that requires the sale of that asset to pay the tax bill. So all of that can be addressed through proper planning. We just need the time in advance for that. Okay.
So for RSPs converting to a RIF, it's almost like in those beginning slides when we were talking about the front nine and the back nine, where in the front nine, you're saving, you're accumulating. So those would be your RSPs. And then the back nine would be the RIFs. So what happens there? We get a lot of questions with, well, what's a RIF? Like, what do I do with my RSP? Not much changes. The holdings can still stay the same. We'll obviously always check the allocation to make sure that fits your risk tolerance. But some people say, well, do I have to wait till age 71 to set that up? The answer is no. You can set them up earlier. And then we also have people saying, well, what if I don't need the minimum amount? What do I do with it? Well, you can always apply that to something like a TFSA, maybe to put into a participating insurance as well. There's other options that you can use your RIF income for. And all it is just a prescribed formula. It's based on the difference of your age and age 90. The minimum amount's just around 5% right now. And yeah, that's the RIFs right there. So moving on to estate goals, this is a big part of your retirement planning as well. So we're always checking to make sure, are your wills congruent? Is your enduring power of attorney and personal directive properly drawn up? Some people think, okay, well, I've completed that, I'm done. Not always the case. Having your personal document set up is only about 20% of the way there. We can honestly make it easy, and we can make it fun and put a positive spin on this so that you're living your last years the way you want to and doing what matters most to you. Also, reference our books here. So we have the Willing Wisdom book by Tom Deans. Many of you were on that first webinar that we did, which is available on demand on YouTube. Complete your index if you haven't already. If you don't know how to do that, just let me know and I can send you the link to get that going. Another important thing too is, okay, now I've done my estate planning, but a lot of the times have my parents taking care of theirs. So we can help plan parents as well. We're having a lot of conversations these days about making sure that our clients' parents are prepared for all these documents as well.
We work with many client households where there's multiple generations involved, and that's when we really do our best work. So while we're bringing up some of the estate topics, is it really works hand in hand with your retirement plan as well. So we just want to make sure that what you'd like to see happen actually does happen, and that we only pay our fair amount of tax. So through proper strategy, you might be able to have more go to the generation below you than you would have go to the government. And that all that takes sometimes is proper planning and awareness as to what that looks like from a tax impact. So the other thing is just having a purpose behind your money. Again, this really impacts every client household differently, but we can help you understand how to give money back. Some of our biggest successes for those that wanted to impact their children or their grandchildren or beyond is that we've helped them attain the confidence or the security to give that away while they're alive, almost like a living legacy, where if they've helped their children, their adult children, pay off their mortgages early, because we've got more than enough to finance and support their retirement lifestyle, it's just brought them such great joy to kind of give that leg up to that next generation. Other people have taken 6 months off and done a working sabbatical around Europe, for example, with their early teenage kids, when it was really be able to provide an impact to them. So it's really a question of how do you want to impact others. So we've got many different tools that we can use to achieve that, including strategies for grandparents to have an impact on the grandkids. So if that's contributing to their post-secondary education, maybe that gives their adult children more capacity to pay off their mortgage early, for example. So really that's the value of some of that insurance too, where it's almost like a multifunctional tool, where if that participating insurance that has cash value is used to subsidize your retirement income, it can also play a role if there's death benefit left over to offset any tax implications. For example, if there's RSPs that are rolled over, or when they convert to RIFs, if you're, for example, let's say in your 70s, upon first death, that'll roll over to your spouse tax-free. But many people don't realize that between 46 and 49% upon second death of that value of those accounts go to tax. So some people get a lot of, I guess, mental joy from knowing that their whole amount of everything they've worked so hard to create over their lifetime will get transitioned somewhere, as opposed to a certain slice of that pie unduly going to the government just because we haven't planned in advance. So that can happen through part of your retirement plan, and we'll blend that to being your estate plan. So this again just kind of goes back to that theme. We're trying to attain what matters most to you, and that'll be part of your plan. This is a short commercial just for the what matters most process and the binder, and just reassurance that both Pam and I are certified executor advisors now. So what we've found through this, what matters most to people is getting their kids, their adult children, off on the right start with proper financial habits. So that can be part of this conversation. Or just the sense of peace, I guess, from knowing that your parents are coordinated and that your sibling relationships will be preserved because you've been able to have maybe some family meetings and be coordinated and generate that conversation. So that can happen through this process, and that's what's had a long-lasting impact for a lot of our clients that we work with multiple generations. It's just that conversation that gets generated through some of this. Leading into this is the question can be asked, what is the health or the wealth of your health plan? So how good is your health, and how knowledgeable are you in terms of your family history? And so some of those questions can really pay off. And with a lot of our clients are in the medical community, but we're sharing those best practices just in terms of baseline testing and we talked about being prepared for any eventuality. That's where we might have critical illness policies that'll again give your retirement plan income stability, where if you have a payout upon like a major diagnosis, for example. So we'll continue to share some of those best practices and ways to maintain and improve your health, which is a key factor for your retirement plans. And then the next concept is, what is the health of your wealth plan? So that's where we kind of dive into it and say, do you know your numbers? Do you know what you want your lifestyle expense level to be? Are you currently saving enough to be on track for that possibility? So then work becomes optional. You move into it with confidence. that's where we can say, how healthy is your wealth plan? And that's where Jeff specializes in testing and forecasting for that, and we support him in that work.
So just to talk about our process, I just want to make an important point here. This is not a 10-minute exercise. The more that you put up front, the better and more meaningful this plan is going to be for you. We need you to be engaged, and the first 3 topics start with you to help us plan together better. So even if we're 10 years away from work optional lifestyle, the focus is on strategically allocating savings to your tax efficient assets. And in order to retire happy, we have to pay first and then we enjoy later. So for the first step here, we always want to see where you're at in your life. Is it a time-driven event? So that could be something like positioning a target retirement date, or maybe retiring the same date as your partner, or maybe changing lifestyle in retirement. It could be event-driven, so that could be new grandchildren in the mix, maybe a change in health, aging parents, marital breakdown, an illness or disability. So there's many different events that can come up, and we just want to make sure that we're assessing those right away. Anytime one of those happen, we need to reassess. The next step is determining lifestyle and your time objectives. So how are you going to spend your time? Let's confirm your lifestyle. Let's see if maybe we need to work part-time, maybe we don't need to work at all, or maybe we need to check out self-employment, because that can always have a huge impact on maintaining your lifestyle, maintaining your physical and mental well-being as well. Another key factor is, where will you reside? Are you going to stay where you are right now? Maybe you're going to a different province. So we need to look at the whole picture. And in the retirement worksheet on the last 2 pages on the Time Hub, that's the information that you can fill in there so that we know how to move forward. And then moving on to number 3, what are your goals? What are your priorities? What is your initial income target? What are we doing with additional cash flow in the early years? So these are all questions that come up. Number 4, create income needed through layering. So just like the cake example that we went through, how are we drawing income in the most tax effective way? Number 5, we align the investments with the plan. So we're always considering income streams for your plan, ensuring efficient asset allocation between the registered and non-registered accounts. So we want to make sure that you're in control of what you can control and not worrying about what you can't control, like the markets, like interest rates. We have no control over that, but we can control how we're allocating your investments. And then the last step, what we do in every meeting, is just updating your net worth. So we always track progress and we roll actuals forward. It's important to realize where you've been, where you are today, and where you're going. So every time we connect for this forecasting process, we're making assumptions and we're documenting them, whether that's return on investment, inflation, interest rates, all those things matter. So moving on to the next slide.
Yeah, and I was just going to add, Jeff, typically
Yep.
it's between that May and July timeframe of each year that we would tell people, okay, let's do a major update to your forecast or a major update to your plan. Would you agree with that?
Absolutely, that's the perfect time to do it. Tax returns have been complete. We know what your incomes were from last year, so we can accurately forecast for the future. So definitely that's the time to do it. So just moving into what is the risk? So there are risks that come with retirement. What we're seeing right now is we're in a very low interest rate environment. Interest rates are the lowest we've seen in a very long time. Equities are becoming extremely volatile, as we've seen in the markets with COVID. They are evoking fear. So this can change the portfolio. Many of our clients, though, it's not affecting them. Because we've been planning this years and years in advance. With this blip in the market, it's not going to affect their overall plan, which we're happy about. There could be another risk, is a significant change in CPP. There could also be limited private sector participation in the defined benefit pension plan. We also have a growing risk of medical expenses that keep increasing every year, increasing government debt. Another risk is longevity risk. So outliving your assets. People are living longer now. So what do we do if we live past age 100? How is our plan protecting us? Another big plan is, not managing your lifestyle, overspending, not sticking to the plan. This will deteriorate your cash flow and not let you live the way you want to live. Another risk is not having your plan at all. So as you can see, there's a ton of risks that happen, and we're always addressing it. We're on top of it, and that's why you have us to help guide you through these.
And we'll encourage that kind of conversation in our annual updates of these plans. It's not just one forecast, we're done, we move on. We'll complete that, and then we use it as a baseline for future planning. And then at some point, we can almost calculate the sensitivity to some of these risks. So we could put in a couple different scenarios, for example. Let's say you travel twice as much between the ages of 65 and 70, for example. What would that do to your long-term plan? Well, we can show you. Or if we could show you the impact of inflation, for example, or of living to age 105. So based on your input, we can show you the sensitivity of your retirement plan to some of these risks.
So here's a snapshot from the actual plan that shows a comparison. So we did a current plan versus a proposed plan. And in that bar graph at the top there, it shows you if you're on track or not. So our goal obviously is to be at 100% in the strong. So it's important that we, get the data, confirm the numbers, and that we're confirming that you are able to reach those goals. There's many different scenarios that we can look at, whether it's retiring at age 55 compared to age 60, maybe there's a major purchase in there as well. So we can test, like Kelly was saying, whether you or not you're on track to hit that goal. So cash flow. This is a snapshot here of a 5-year cash flow that we completed for Ken and Shirley. This is so important because it gives you the perspective to see 5 years down the road exactly what's happening with all your money. We don't want to be living day to day, not having a plan in place and just kind of going with the flow. We want to make sure that we're planning for major expenses that are coming up in the next 5 years. And that's what this exercise allows us to complete. And what you're going to get out of this is more confidence and more security from knowing your numbers.
And when this is done well, it's not budgeting where you need to live underneath a number. That's an old school way of thinking. What this is an exciting, positive way to map out and choose intentionally your lifestyle level. So some years might be greater than others, but you want to consciously choose that and have a plan for it, which is really where the security of your retirement plan comes from, is knowing your numbers.
So another exercise is tracking your net worth. It's critical that we're always tracking your net worth. We need to know everything that you have in order to provide you with an accurate forecast. So obviously we have access to everything that we hold, but it's important that you update us on anything that's outside of the Tower Group. This could even be updating your principal residence value of the home, because that plays a big part of your net worth. If there's a mortgage, updating us with what our payments are, what the interest rate is. If it's coming up for renewal, we can help negotiate like a new renewal for you. So we need to make sure that we're tracking everything, because it doesn't make sense to just track half your plan. Why would we do that? We want to give you the most detailed, comprehensive plan possible. So that's where we need your help. If there's anything that we need to add, please let us know.
And then it comes down to from your accumulation years and then your deaccumulation years. So then that's where you're converting your net worth to an income stream, which is what the whole point of this whole process is.
So this slide here kind of encompasses all the previous slides that we've gone through, because we've confirmed your lifestyle expenses. We know what your cash flow is. So now we can look at strategically drawing your assets during retirement. So as you can see in this chart here, from age 62 to 80, we're showing where that money's coming from. Each bucket of assets plays a different role in the plan, and having that foresight to see what that looks like down the road, once again, more confidence, more security for you as the individual.
And we're trying to show you examples of the screenshots that you'll see from your retirement plan.
So on to the case study for Ken and Shirley. You probably have the case study in front of you right now, but just to go through it here, Ken retired 2 years ago, Shirley 6. Here's a summary of the investments that they hold. So they came to us. Typically, we like to not, jump right in straight to retirement plan with new clients. We like to give like at least a 10-year plan here to get ready for retirement. But with Ken and Shirley, it was a little bit different, and we'll walk you through what we found with their plan. So just to give you some background, they're content with living at home, no plans to move in the future. They like to spend their time traveling in the winter. Ken has self-employment income of $50,000 after tax. They're both in good health, and they maintain a regular fitness routine. Current lifestyle, $6,500 a month, and what matters most to them is spending time with the grandchildren, and they have a big family tree with aging parents and 2 children and 3 grandchildren. So a lot happening right there. So some improvements that we saw from their plan when they came to us was we're not layering their income properly. So by properly layering the income, we were able to save them $12,000 in tax just in that first year of retirement. We have structured their plan differently. They were going to do non-registered withdrawals only, but by income layering, pension splitting, and tax loss selling, these are just a few of the ways that we helped Ken and Shirley improve their retirement plan.
And they didn't have equal pools of registered assets. So with the time horizon that we had left before they retired, we were able to make that a little bit more equal. So why you would want equal pools of registered assets is just so that it makes it easier to have similar or equalized pools of income in retirement. And that's really what the whole point or the goal of retirement income planning is to manage your annual tax. So they also had a thought around, okay, family's important to us, but they didn't know the method or the vehicle for how to express that care and consideration from a financial angle. They were doing some family vacations all the time, and they were close and helped supporting some of the grandkids with time and attention there, and making it they did an Alaska cruise with some of their parents. But what we were able to say is, if you contribute to your grandchildren's education savings, and we gave them the security to say, okay, you have enough to be able to fund that, then it allowed them to, I guess, make a leap forward for the whole family tree. So then, as we mentioned prior, that concept is the adult children can pay off their mortgage quicker because they don't have to do the $2,500 per annum for each child for the post-secondary savings. So it went a long ways there. And then with the charitable giving ideas, that's where, in coordination between their will and their estate planning, as well as their retirement planning, we were able to give their executor powers to make a charitable contribution if that's what made sense from a tax angle on that second death. So instead of funds going to the government due to improper planning, more of those assets would go to the family tree, and the grandkids is who they eventually chose to leave that through in terms of their estate planning. So as well, they were able to spend more in their 60s on travel because they had long-term care coverage. So we didn't need to keep an investment account buffer for long-term care when they were thinking at age 85 and beyond. Based on what they had seen for their parents. If they've got the insurance, it makes it cents on the dollar for paying that future cost. They also had the impact of some self-employment made a huge difference to what they could spend in active retirement. So Jeff, I think you almost have like 3 tiers of when people have for lifestyle spending in retirement.
Yeah, typically in your first 10 to 15 years of being in retirement, those are your golden years. So that's when you are the most healthy, You have the most flexibility to travel. You can do the most that you want to do. So in those years, we're saying, yeah, great, live that lifestyle, like hit that bucket list, do everything you want to do. But as you get older, say around age 75, you're not as mobile, you're not going out as much, you're probably staying in more. So it's important to note you're not going to live the same lifestyle you were living in your golden years. So what we do is we say, okay, maybe age 75 to age 85, let's dial back the lifestyle. Instead of a 6,500 lifestyle like Ken and Shirley, we'll say it's $5,000. And it's never a problem to hit that lifestyle or anything like that. It's just the facts of getting older. You're just not spending as much money. You're not doing as much, which is totally fine. And then if you continue to live longer than that, 85 to 95, dial it back again. So like how I was saying, tiered expenses. As you get older, you're not spending as much, which is the bottom line.
Yeah, and Ken found himself that type of person that just needed to be mentally engaged and feeling useful to kind of feel fulfilled in retirement. And I think a lot of us that have been at home recently for almost too much time have been, you've been able to see that test. You know, we've given a lot of time on your own at home. What do you do with that time? How do you fill it up? Do you drive yourself nuts or your family nuts? Like, what are you going to do in retirement mode for those hobbies? So it's an interesting test in that way. But Ken found a consulting contract that didn't really feel too much like work. It only took him 4 to 6 months every year for those years between age 61 and 65. And then it had a huge impact to the plan because we didn't have to take RSPs and convert them to a RIF and grab the income too early. So it gave them a huge amount of legacy spending as well as buffer for the long run. As well, Jeff, you mentioned that we achieved some tax efficiency through planning with their accountant and 12 grand in that first year, but there was almost 8 or 9 grand for about 10 to 12 years just in tax efficiencies. So we've got those plans in terms of our service models. The legacy model, for example, really gets you coordination of that estate plan to your retirement plan and some in-depth tax consulting with your accounting. And there's a team that, even though you might not think that your situation is too complicated, you can get value from that and be benefiting from us as well as the accountant giving you some of those tax efficiencies. So that's almost like a free 8 grand vacation every year because of just tax savings alone.
So we've spoke to the results of the case study. Here's just a little bit more. They were able to live their lifestyle, and that was mostly due to Ken having that self-employment income. The insurance cash value supplemented the income from age 80 for $10,000 a year per person, which was huge. CPP began at age 60, OAS at 65, and we were able to avoid those clawbacks like we talked about earlier. They left an impact to the next generation. So family was super important to them, and being able to pass that legacy down to the children, to not have to worry about the RESPs and focus on other things was really awesome. We implemented critical illness and life insurance to buffer the financial risk. So Ken and Shirley came in and they never had that. So it was important that we did a risk management review to make sure that in the event something were to happen, they were protected as well as their family. And then we got the wills complete and the personal directives and the enduring power of attorneys. And overall, it generated a great conversation. And overall, they left feeling confident, secure, and having the peace of mind that they were on track to live the lifestyle that they wanted to live.
And Jeff, what Ken said is that they only had confidence to spend according to their plan in their active retirement years because they had that life insurance that lasts their whole life and that critical illness. So then, like you said, it buffers the financial risk of if you don't have those policies, you would then have to grab from your investment assets, pay the tax hit in some of those major situations. So planning for some of that gave them the mental freedom to achieve their travel plans basically in their late 60s.
So that leads us to our last slide. So if you have any questions, just hit the drop down, type your question, send it over, and we will answer it right away. So let me just check here to see who's contributed. So we do have a question from Brenda. She says, are you saying my retirement can be affected by critical illness or bad health? Can you explain that in more detail?
Sure, I can address that, and then Jeff, you can chime in if you have anything to add. But what I think is people's plans or absence thereof definitely might have an impact to your future retirement income stream. So for example, if we just have a mortgage-free house and a bunch of investment assets that are performing well, but then if there's a major diagnosis of cancer, for example, at 72, and we choose consciously to seek alternative treatment or get past a waiting line, and that costs us about 70 grand to 80 grand is what we're normally seeing. And if we have to grab that from your investment assets, obviously that would affect the stability of your future income streams. In the situation of, for example, 100 grand or 150K of tax-free payout, it also is easier to have that money mentally, you can allocate it to this cause. So some people have found, wow, I don't want to take out 110,000 from my RSP to pay the 70 grand to get well down in the States and to bypass a line and to look at some alternative therapies. It's really hard for them to drain their assets too quick. But on the flip side, if they have a tax-free payout from this critical illness policy, and that's where we've seen both scenarios. We just feel like it's an informed choice. We kind of give you those options all the way through. But those people that have grabbed a critical illness policy and then see a payout, it's a lot easier to pay for those treatments, and then it's saved their retirement income stream. So it's really case by case and file by file, but that's kind of the example of the two alternatives as to how it could affect your retirement plan.
So our next question comes from James. James is asking, what's the best way to save tax? Everyone pays too much tax on the retirement side. Is that the cake, or what specific difference does that make?
I would suggest that it's, through the process that we're very unique in terms of the depth that we go to. A lot of advisors might just grab one or two concepts and not integrate the plan together. But it's through plan integration involving maybe an accountant and a lawyer and the whole team and the pool of expertise that we have that gives you that tax efficiency. So we're going through your tax return in depth at tax filing time, like right now, but then through our regular meetings, we're also explaining how to take money that's beyond an RSP and a TFSA. You might have it invested in a taxable account. So are there other tax-free ways that we can invest money? And so then that can help save tax. The concept of an RSP, a lot of people forget that they received maybe a reduction in annual tax payable. Let's say they're 42 and they're making $100,000 and contributing $25,000 to their RSP. That saves them an amount in their annual tax in that year. And maybe that tax refund can go to paying down their mortgage quicker. But then later, through their retirement years, call it 60 to 90, they're paying tax when they withdraw from that RSP. So we're helping them strike that right balance for RSP contributions in this year as well to kind of save your annual tax. Would you add anything to that, Jeff?
No, I think that's pretty much all of it right there. We have another question from Ryan. Ryan's asking, is it important to plan for care homes or have home care or increased medical costs over time? Should I get into those details now when I'm 50?
Well, I think the earlier the better that you can get into some of those concepts. We haven't done, through the Tower Group, we haven't looked at long-term care insurance much in the past because the insurers haven't offered a quality contract for that up until now. And so what we're doing is helping people calculate their ability to cover that cost through their own methods. So Jeff, one of the byproducts of your plan is you might see an estate value at age 85 or 90 or 95. So one school of thought is that you might want to keep a buffer of your real estate assets to pay for that cost. But in addition to that, what you might want to explore is how can you be covered for that partly through insurance. So there's a couple providers that now offer a long-term care product or even a critical illness contract that converts to a long-term care. And beyond long-term care, there's also a retirement health assist. So we can explore different costs that would occur there, because definitely from a family history angle, some people see an exponential rise in their monthly costs or their annual costs related to their health and medical expenses. And so I guess the bottom line to that is there may be a way to more cost effectively cover that cost through use of insurance, and that has to be taken by the time you're 45 to 55, right in that window.
Next question comes from Terry. He asks, how do I come up with life after work ideas for businesses? Where can I get started? How do I know if I'm even good at it?
I think we have a process for that. Do you want to jump into that, Jeff, in terms of our next opportunity plan and some of the consulting that we've done for our professional employed people that jump at a self-employed business?
Well, it's what's your passion? Like, what drives you? What are you excited about? And like, do you like working with people? Do you like being independent? It's really defining like, okay, this is what I really care about. This is what I want to do. Now, what can I pursue to monetize that? And we can help walk you through that. Many times people just don't know where to start. Like Kelly was saying, we do have a process for that. And to me, it's just like, I want to be spending my time doing something that I enjoy, whether it's giving back to the community, whether it's doing something that I get fulfillment out of. I don't just want to be doing something to get a paycheck. So it's really kind of working with the team, working with Pam and Kelly on just finding out like, what is that? Like what drives that, and how can I be successful with that? Because we've helped many people before, and we get them all the time. Like, I want to kind of go this avenue. How do I get started? What do I do? The first step is just a conversation with us, and then we can walk you through the process.
I think that's what we're known for, is based on your comments and questions and requests, we'll jump at it and try to assist. And we've been successful in the past with a number of different examples that I'm thinking about, where people approached us and said, I know I want to make a change, but I don't know what I want to make a change to. And just like Jeff suggested, we can kind of walk you through brainstorming and then planning and understanding what that would look like from a business model. And then a lot of the boring details in terms of like setting up a company and the bookkeeping and the accounting and tax, that's what we specialize in. So then you've got a partner that is passionate about what other people think are boring, and we can put you, based on your unique ability, what you're loving to do and creating value for others, that's what you focus on with that time. So it's really a good partnership in that way.
Okay, last question comes from Tina. You mentioned annuities. What are the pros and cons of an annuity?
Well, the pros is that you have guaranteed monthly and annual income. So if you convert a large portion of your investment assets to an annuity, which typically you would try to do if interest rates are high, then the pro or the benefit is that you've got that guarantee. The con is that money is basically gone. If we've given it to a conventional life annuity, and then all of a sudden, for example, there's an unexpected death, there's a lot of that money evaporates basically. It's not really given to the next generation. So you can have some guarantee periods where it can go to your named beneficiary there, but that's the main con. It's really kind of locked in. So as you can imagine, with the baby boomer generation and a lot of people retiring in the last number of years and coming up, the financial industry has looked to, seek and produce different alternatives for that. So there are a number of different things that we could maybe grasp onto that give you guaranteed income for life, where you don't have to give all of the funds away for that. So what we're locking into is an actual rate of return. So it's almost like a pseudo annuity. So it's kind of halfway to that.
Okay, thanks, Kelly. Well, that's all the time we have today for questions. Thank you, everyone, for attending the webinar. And if you have any questions after the webinar, you can always email us at info@thetowergroup.ca, and we'll get back to you right away. I'll pass it over to you, Kelly, for any final thoughts, and then we'll end it on there.
Thanks, Jeff, and thanks for the presentation and for everybody for attending and taking the time out. We'll also send and have available the retirement forecasting worksheet, as well as the top takeaways, the 7 top takeaways from today's presentation. So what our hope is that it'll generate a lot more conversation going forward, and we look forward to chatting and meeting with all of you very soon. Thanks so much.
Thanks, everyone.